Hello friends, welcome back to my weekly market outlook video. I'm pleased as a punch that what we have been talking about since many weeks, namely bond yields, inflation, dollar prices, the dollar index, the impact of rising crude oil prices as a multiplier commodity which makes fruits, vegetables, etc. all very expensive, is now become the talk of the town. You, my dear viewer, as the viewer of my videos, has been not just a few steps ahead, but a few miles ahead of the competition. And like I promised you in my videos, I will slowly but surely definitely open up the doors to our in-house statistical model, the Barracuda, and share with you more and more studies, which of course are not found anywhere in the public domain because these happen to be our in-house statistical model which we've developed ourselves. I'm Vijay Bhambwani, a trader with 35 years experience in the market, 28 of which are as a founder, promoter and CEO of a limited company that trades for a living. And I'm here to help you become better traders with no commitments, nothing required in reciprocation from your side. So let's dive right in. First, we take a look at the market roundup. The market actually witnessed a rally in the first three trading sessions, which actually flattered to deceive. All right. And the last two trading sessions, Thursday and Friday, the markets actually turned turtle, fell on a dime without any adequate warning, which is what I have been warning you about on my social media pages. If you do connect with me on my social media accounts, you can watch a lot of extremely simple, extremely easy to understand statistical tools by way of graphics and pictures as to how I tell you to do what. And I have been telling you that statistical beta or pure price volatility has jumped by leaps and bounds and you should be extremely careful. So, we traders will face the challenge of this statistical beta and we'll have to proceed extremely carefully. And now that the media, both mainstream and social media, including online chat rooms and groups, etc., WhatsApp, etc., are talking about bond yield, inflations, etc., we are going to take a good hard look at a health check of all these indicators. And I also stress upon the fact that you absolutely must cultivate a 360-degree worldview of looking at everything that impacts the price because we trade the price. Now on your screen you can make out that the Nifty has very clearly outperformed the Bank Nifty, and you should not be surprised as others are because you've been basically getting updates on my social media pages about how the bond yields have been constantly rising, the dollar has been rising, oil prices have been going up, which has impacted the bank's mark-to-market portfolio of bonds that they hold. Banks are the biggest holders of bonds, and therefore any losses in the bond prices directly impacts the banking stocks and by extension the Bank Nifty. Now, the dollar also strengthened, which can be seen from the Dixie, which is not on your screen, unfortunately. I only show you the USD INR. The USD INR has risen, fallen, which means the rupee has strengthened against the dollar. But in the international domain, the Dixie has risen, which has basically pressurized bullion prices. It's also created some amount of downward pressure on industrial metals, which is base metals. Now, commodity prices are likely to feel pressured, but look at the price of crude oil. And I've often warned you that crude is a multiplier commodity. If it gets expensive, everything from milk, eggs, vegetables, fruits, grains, spices, cereals, etc. all get expensive, and there you go, your taxi fares and auto rickshaw fares, etc. have started moving up, and believe me, the market notes all these facts, and so should you. So bond yields rose 4 basis points on a week-on-week basis, and that caused pressure on banking stocks and the Bank Nifty. We'll of course talk in greater detail when I come to the 10-year bond yield segment. Coming up on your screen now is the MWPL or market wide position limits charts, and it tells you that as in when the March future started gaining traction, remember we had an expiry recently, traders started raising their exposure levels, which is but natural. On expiry day they actually square up a lot of their positions only to raise them again in the next settlement. So from here onwards, I do feel MWPL will go up, which is routine. And also, I have a very critical market update towards the end of this video. So don't log out of this video. Watch it till the fag end. Now look at the volumes chart. Now this week, the volumes chart is a little different because the data from the NSE is incomplete. They have been unable to upload all the data that they do end of the day. So Friday's data is missing in bits and pieces. What I have done is given you prompt month futures of the Nifty and the Bank Nifty. Normally I show you cumulative futures of individual stocks and cumulative futures of indices. Both Nifty and Bank Nifty merged together. This time I'm only showing you the data that NSE has given me, which is the Nifty and the Bank Nifty March month futures. So the chart shows the volumes are rising on both indices, but the Bank Nifty, which is shown as a red line, the volumes continued to rise even on bearish days, which tells me that selling participation on the Bank Nifty is fairly high. And the basis chart that's on your screen now shows that the futures premium fell fairly sharply on Thursday and Friday because selling pressure escalated. Now, people who are trading in call options, especially buyers of call options, would have realized that on Thursday and Friday the options premium eroded very, very rapidly. Hey, options premium basically react a little late. It is basically the futures premium as opposed to cash, which is even more sensitive. So if you connect with me on social media, by the end of the day, you will see that this basis chart which you're seeing on your screen, I updated end of the day every day on a working trading session. So now on your screen is a recent study which we shared with you, and many more are coming your way from our in-house statistical model, the Barracuda. This particular study is the impetus. Impetus means the acceleration or deceleration in the price movement. Now take a look at the impetus chart. It basically shows that there is a possibility of the markets being range bound because the impetus is going sideways. As a matter of fact, the Bank Nifty impetus on a relative comparative basis with the Nifty 50 is showing marginally weaker. So this is corroborated by the fact that bond yields will impact the Bank Nifty first and the Nifty later. So here you have the second stage of evidence that the impetus itself on the Bank Nifty is relatively weaker than the Nifty 50. So now the impetus done, we will go to the segment where I talk about the 10-year benchmark bond yields. The bond yields last week were in a tizzy because the yields rose 4 basis points. Now that's extremely big for the bond market. Now the bond markets are taking a stand against the RBI, RBI wants lower benchmark policy rates, and the primary bond dealers are basically opposing that move because they are demanding higher interest rates. So they are selling the bonds and causing the price to fall, thereby raising the yield higher. Now the cost of doing business goes up when the cost of capital goes up, which means even trading and investment becomes a little more expensive because money becomes more expensive to get by, which means rising interest rates. Business owners will instantly identify with what I am saying. They'll recognize this fact, and which is why, as a business owner, as a guy who runs a company coming from a business family, I keep telling you to watch everything that impacts the price. Don't just go on hearsay and open your mind to any and every idea that's floating around in cyberspace. Now, do note that the RBI has the task of raising rupees 12 lakh crores from the bond market in FY 2021-22, which is starting from 1st April, and is deliberately wanting to push yields lower so that it can control inflation. Number one, by way of curbing the dollar also. It's been controlling the dollar price against the rupee, and it is pushing down yields on bonds because it wants to borrow 12 lakh crores in the coming year, so that pushing yields will result in cost savings for the government itself. Now, the markets are volatile because primary dealers in the bond markets are not convinced of this move of the RBI. And this factor will have a massive impact on banking stocks and Bank Nifty because the banks, like I told you, are the biggest investors in bonds, and they are suffering mark-to-market losses on their holdings. I've been telling you that since many, many weeks, and it actually brought a smile to my face when some of the newspapers and television channels are now talking about it. Now, you can connect with me on social media. This is information that I update day on day, end of the market. So we can basically keep you updated here in real time. The bond market done. Now let's proceed to another very critical but neglected aspect of the market, the Dixie, the US dollar index. Now this is the US dollar price against the global basket of currencies put together. Now, why do people neglect it? Because they ignore the fact that India is a net import dependent nation. 2/3 of our imports are fossil fuels. If the dollar becomes expensive, all our landed cost of imported goods become expensive. Oil price becomes expensive, which I told you is a multiplier commodity and causes inflation to go up. So all emerging markets, especially import dependent nations, want a weak dollar. But unfortunately for us, the dollar is now in an upward trajectory. So our import bills are likely to go up, and the savvy traders watch this aspect very, very keenly. And the fact that you're watching this video, it means you are thinking, thoughtful, deep-minded traders who care to look at things that others don't watch. Now, leave the cynics alone and do your own thing. Look at everything that impacts the price, because like I said earlier, price is what we trade. Coming up on your screen is the dollar index chart. Look at the price pattern. It shows a very strong surge, and the price is convincingly now settled above its 25-day moving average, exponential moving average, which itself is rising, and the 91.5 hurdle that I have been talking about since a couple of weeks has come and gone. It's been overcome very, very convincingly. As a matter of fact, it might just become a tentative support on the downside if the Dixie was to fall. So watch out for more volatility in our financial markets, because the dollar index is likely to exert downward pressure. Now, in the end of the video, I'll also want to share with you a critical aspect of the market and especially volatility and why it is going to go up in this particular week especially. So stick around to the end, my friends. Now, last week, I advocated a range between 92 on the upside and 89.75 on the downside, which held more or less because Friday's intraday peak was higher than 92. In the coming week, I see an estimated, I repeat the word estimated, range between 93.15 on the upside and 90.80 on the downside. Now watch this space very keenly, because it will impact your commodity prices, bond yields, overall inflation, and therefore equity markets also. Friends, now the dollar index done, we go to the Bank Nifty. Look at the chart of the Bank Nifty on your screen. The first thing that strikes me when I see this daily chart is that this index is relatively weaker than the Nifty. Note how the price is just about holding at the 25-day exponential moving average, And this index gained only 1.22% on a week-on-week basis against 2.81% gains of the Nifty last week. And my regular viewers will also know why. The primary reason is bond yields, which I've been telling you, and the bond yields have basically risen 4 basis points last week. Don't let anybody convince you otherwise that bond yields are not connected to the Bank Nifty, because they definitely are. Now, this Friday's low was just about marginally higher than the previous Friday's low, which is why the Bank Nifty is relatively weaker than the Nifty. Nifty's low is actually way above the previous Friday's low. Now, I warned you about not going long last week unless the bulls overcame, and not just overcome but keep the Bank Nifty trading above the previous Thursday high on 25th of February, which was at 37,232 levels in the spot segment, which could not happen. Also note how the price is at the blue dotted trend line, the 25-day exponential moving average, and also the previous bottom, which makes it a double bottom. So any violation of the 34,658 level will automatically open the doors for further declines. Therefore, I advocate that you stay away from any fresh momentum long positions unless the bulls convince us that they are serious about taking the market higher by way of keeping the Bank Nifty above the 36,455 levels on a sustainable closing basis for at least 1 or 2 trading sessions. And look at the weekly chart now on your screen. It shows an inverted hammer contained within the previous bearish candle, which validates my point that the Bank Nifty was relatively weaker than the Nifty last week. Remember, the impetus chart also confirmed the same, and in the week before last, this index was number 2 on the most volatile list. Last week, also it maintained this position of being number 2 on the volatility list. And last week I advocated a range between 36,750 on the upside and 32,850, which held perfectly. The next week's estimated, I stress upon the word estimated, range is between 37,150 on the upside and 33,300 on the downside. Now keep watching the market snapshot and the daily ranges that I post on my social media accounts late evening every day on the end of the day. And continue to trade light, because you should be avoiding shocks that high volatility invariably brings in the marketplace. So let's be careful out there and avoid any kind of aggression in your trading. Be very cool, trade light so that you can handle the risk management portion fairly well. Friends, the Bank Nifty done. Let's now go to the Nifty 50, which is the most liquid and low impact cost tradable counter on the NSE FNO list. Now this index has bounced off to a bullish start last week, and even though it fell on Thursday and Friday, it still closed above the 25-day exponential moving average. Last week I advocated that we must let the impetus and the price tell us where the markets were going rather than second guessing. And the peak of Thursday, the previous Thursday, which is 25th of February 2021 at 15,177, needed to be surpassed on a sustained closing basis before we could attempt fresh longs. Unfortunately, it went past this 15,177 level and closed about it only on one day rather than sustained closing basis, which was previous Thursday, right? Which was the 3rd of March. Now, the markets failed to sustain these higher levels. They flattered to deceive the bulls, and Thursday and Friday were slam dunk days. They fell extremely hard. And the impetus chart, which I showed you earlier, it was pointing towards a flattish kind of range-bound day for the coming week, unless and until some really large price moves or any news media based triggers really occur. Now, last week's high of 15,273 will be a very strong litmus test for the bulls. They need to take the Nifty up. I'm talking of the spot segment now. They need to take the Nifty above the 15,273 levels and keep it trading above that on a closing basis for a couple of trading sessions. That is when they will get in the driver's seat again and you can contemplate going long on the momentum side. I'm not talking of bottom fishing. I'm talking of momentum. Now let's come to the weekly chart where the bullish candle resembles a hammer, though not a perfect one because the upper shadow is not really very prominent. So this shows that while the net gains were seen on the Nifty index, higher levels were unsustainable. And the inverted hammer candle is contained within its previous bearish candle, which means the bulls were held in check by the bears. The price, however, remained above its 25-week exponential moving average, which tells me that the overall long-term trend still remains upwards, which is bullish. So delivery-based long-term investors have nothing to worry even now. Now watch the 14,638 level, which is the weekly low of the week just gone by, for signs of support. Now as long as this holds, the rally may continue. But if this level is broken, the bulls may be in trouble. And the week before last, this index was at number 8 on the most volatile list, where it remained even last week. So the volatility ranking did not change. The range that I advocated last week between 15,100 on the upside and 13,950 on the downside was overcome by a little over 150 points, but the markets slid down immediately on the next day. Now, in the coming week, I estimate, I'm stressing on the word estimate here, the range between 15,525 on the upside and 14,350 on the downside. I think you should continue to trade light and stay sharp, because there will be very sudden and sharp price moves in the market because of the fact that volatility has risen very sharply. Now friends, I come to the most popular and anticipated segment of our video, which is the high and low impetus stocks. I'm going to show you a list of 5 stocks that are very high in beta, which means you take small exposure on them, wait for large price move to earn your profits. And 5 stocks which are low impetus, low beta, where you take larger exposure on them and wait for very small price moves. So high beta, high impetus stocks coming up on your screen are led by HDFC AMC at number 1. Number 2, Infosys. Number 3, Tata Power. Number 4, Grasim. Number 5, Cummins. Now low beta, low impetus stocks where you take big exposure and wait for small price moves: Dr. Lal, Path Labs, Glenmark Pharma, Cadila Healthcare, Aurobindo Pharma, and Maruti. If you've noticed, 4 out of these 5 stocks are concerned with health or medicine. So do note that these volatility attributes do change from day to day, as I keep posting on my social media accounts, and you can't take this list as something that is cast in stone. The hierarchy of the ranking of these stocks will keep changing on a day-to-day basis, which is why I request you to keep following me and connect with me on social media. Now friends, the most critical update that I have for you about the financial market. Now next week will be truncated, which means shorter, due to a holiday for Shivratri on 11th of March, which is a Thursday, which automatically means that the weekly index expiries will be on Wednesday, and Wednesday will therefore act like a weekend trading session because Friday would be a holiday. Thursday would be a holiday. And when the market opens on Friday, you're going to have 2 more holidays coming up ahead. So you're actually going to see market behavior, weekend type of market behavior twice. First on Wednesday, then on Friday, which automatically means that volatility will go up. Which is why I told you in the section when I was showing you the beta that I have an important update about this market. So this is going to be a challenge for us traders because statistical beta or pure price volatility will spike and aggressive traders can actually take a big knock. Therefore, I suggest you take a cautious approach, trade light, keep your position small, and don't average your losers in the coming week. Friends, I draw to a conclusion of this video, not before reminding you to click like on this video if you agree with what I said, if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. And in the comment section, keep the lines of communication open with me so that we can have conversations going. And I'm going to share with you on the screen my social media contact coordinates where you can feel free to connect with me. We'll get conversations going, talk about markets. I'll share my statistical data on these social media accounts which you can take advantage of. Friends, I wish you a very, very profitable week ahead. Vijay Bhambwani signing off for now. Thank you for watching my video. Take care. Bye-bye.